started here. Welcome everybody to this webinar. We're going to be talking about the Woodstone Manor property. We are lucky enough to have Tyler Devereaux and Lisa Parrish on to answer some questions for us. My name's Jackson Campbell. For those of you that don't know who I am, I work with Multifamily Capital Partners as their loan coordinator, but I also help put on these webinars, which I love doing and I love being a part of. Before we get started, and I'll be the one asking the questions moving forward here. So if anybody has any questions, please throw them in the chat box. Write them out in there. I'll be able to see them. And then I will be able to ask the panelists as well those questions that y'all have. But anyway, before we get started, let's go ahead and have Tyler introduce himself. And then we'll have Lisa introduce herself. Tyler.
No way, man. I'm going to have Lisa go first. Ladies first. Beauty before whatever it is I got going on. So Lisa, you go
Beast
first.
or bald?
Beauty versus beast.
Did you hear what I said? You didn't hear what I said. Okay.
Beast? I'll take beast.
That's not what I said, but we'll go with that. So another B word. I'm Lisa Parrish, and my husband and I, Greg Parrish, and I, we own GLP Investments. We've been in multifamily for about 14 years. And we have about 3,000 units. Most of our portfolios with Ryan and Tyler. And we're really excited to do another deal with Ryan and Tyler. And of course, we have Jackson and Melissa that do deals with us. And it's a really fun, exciting group that I just loved. We have just so much fun that sometimes I forget we're working. So, but that's, I don't know if there's anything else you want me to say, but.
No, that's great, man. That's awesome. Lisa is a rock star, man. And anybody who's on here who knows Lisa knows that. I mean, as we get into this call, you'll see that all this happens because of her and Megan and Brett and Eric who are on here as well. And so I'm just grateful to be here and to be able to participate, alongside and answer some questions about, the market and the deal. My name's Tyler Devereaux. I'm the managing partner of Multifamily Capital Partners, and we own a little over 2,000 units. I should know these things off the top of my head, but I feel like
keep track.
I know. Little over 2,000. That's my go-to. Little over 200 million in assets, and a good majority of y'all here on the webinar are a big part of that. You've played a major role in a whole bunch of those, so we appreciate that. We appreciate you. So been in the business, been in the industry for. He's been in real estate. I acquired my first rental property at 21 and then just kind of done everything from single family flips to buy and hold to big multifamily repositions, and grateful to have transitioned into the multifamily space for sure. Also the CEO of the Multifamily Mindset. That's an education company where we've trained a whole bunch of students on acquiring apartment buildings and then also just maintaining a growth mindset. That's definitely a passion of mine. So there's my background. And once again, I'm just grateful to be here. So,
wealth of knowledge on the phone call today, for sure.
We have Melissa here as well. Melissa's the head of investor relations with Multifamily Capital Partners. And I wanted her to just quickly explain the subscription process. I know that a whole bunch of you have already done your soft commits, but Melissa, can you know those details better than I do? Do you mind running through those?
Of course. So just a quick reminder, we will be sending out a link. That link will specifically let you reserve your investment amount. Then that way, after you reserve your investment amount, we'll send you the subscription documents, which will finalize your reservation. So you can do this at any time. You can do this during the webinar. You can do this after. The most important part is just that you do actually do your reservation so that we can make sure to get you a part of this deal. But as always, feel free to reach out to Tasha or I, and we can make sure that you guys get taken care of. But we will share the link throughout the webinar to make sure that you guys have that as well.
Are you just going to put that in the chat? Is that what you're doing?
Yes. Yep.
Okay, sweet. And then one more thing as well, then Jax, I'll let you take it and run, is questions. But we love to, Jackson has obviously prepared some questions for us we're going to run through, but this is about you. This is about y'all, not us. So feel free to type in any questions at any time. We'll answer those and get y'all squared away with those as well. Want to make sure that, you're just comfortable and understanding, what's going on with the investment that we're getting into. So Jackson, I'll let you take it from there.
Awesome. We'll keep that flow of ladies first, and I'll ask the first question to Lisa. Lisa, you talked about how you guys, in your intro, you talked about how you guys have acquired 3,000 properties, and you guys have continued to acquire properties through the pandemic, through the COVID-19 pandemic. So the first question that I have for you is, how have you been able to maintain the performance through all of those properties through the pandemic?
Okay, just to clarify, it's not 3,000 properties with 3,000 units.
Units,
That'd
my
be a lot
apologies.
of properties.
That's your
That'd be
totally
a
my
lot.
bad. 3,000
No, no
units. Thank you.
Yeah, but definitely COVID has caused challenges for all of us. It would be, untruthful to even pretend that it hasn't. But we have, I've seen a lot of owners through this pandemic who've used it as an excuse for everything. An excuse for, huge delinquencies, excuse for not paying investors, excuse for, getting extensions on their loans or not paying their loans or whatever it is, even losing properties. Rather than using excuses, we were proactive. We did everything that we could to figure out, how do we get our tenants to pay? How do we help our residents be able to, because it was a very stressful time for residents. How do we help them be able to get through this? So even when there were shutdowns and everything else, there were still government agencies that were helping residents be able to pay. But a lot of residents, they were overwhelmed and they didn't know what to do. So we actually would go to them, and rather than just telling them that they need to pay or get out, which we couldn't actually do that anyway. We went to them and we gave them a list of all the government agencies that they could contact, how to contact them. And in some cases, we actually even did the paperwork for them and had them sign off on the personal information, because some people they will use the excuses. We didn't want to use that as an excuse. So really for us, it was being proactive, not reactive. And it was all about figuring out, here are the problems, let's figure out the solutions, not come up with excuses and then pawn it off onto someone else. So we were actually able to get through the pandemic and come out. Now we can start evicting for some of the residents that didn't even care that we were trying to help. It's time for those people to go. And we are working on clearing out delinquencies, and we'll be just fine on the other end.
Awesome.
Dude,
Awesome.
Hey, can I mention one thing on that I love, that I'm just so grateful for Lisa and Greg? They are some of the best operators that I've ever worked with. And it was amazing it's always been amazing for me since we partnered with them to just see how they operate and how they take care of tenants. And taking care of tenants is a big deal to them. And I believe that if you take care of tenants, it always filters down to the bottom line. And that's what they've been able to do. Everyone wants to pay their rent for the most part. Most people want to pay their rent because they know that if they don't pay their rent, the place that they live next will not be as good as the place they live currently. But everywhere online, they're saying, they hear that they don't have to pay. So Lisa takes this proactive approach. I love that that's how you phrase that, proactive versus reactive. And then just letting them know that, no, they do have to pay, and here's the information, and let us help you do that through government resources. So that's it. Just appreciative of that.
No, and a follow-up question that I'd like to ask you on that, Lisa, is I'm sure that says a lot about your operations team and that structure that you have there. Tell us a little bit about your operation teams and how you've been able to work with them through the pandemic and just in general.
Well, of course, it depends on which market we're in. But in every market that we're in, which is, I think possibly another question about, how we're able to scale up. But one of the ways we're able to scale up is that we are, rather than, my husband and I, we used to manage ourselves, and then we used to asset manage everything ourselves, and, helping management companies, we're starting to bring in other people, and we're training other people to actually take on a lot of the day-to-day, jobs that we were normally doing. And now we can oversee them. And still be able to maintain, the quality operations that we've been able to do in the past. But I mean, we have a different team in every market, but it's always been, we're overseeing it. Whether it's my husband and I or Ryan and Tyler, we're overseeing it so that we're making sure that the way that we have learned through our experience to do things is being done that way. And it trickles down, just like Tyler said. I mean, everything trickles down from the top. So if you've got good leadership from the top, and then you can have your people underneath you, and they understand what, how you want things done. And then they're going to make sure that the management company is doing it that way. And then, it all ends up going down to the tenants and the quality of life that the tenants are going to receive. And it all kind of works in tandem.
Awesome.
That answers.
And although it's only 3,000 units, it probably feels like 3,000 properties, like Jay said.
Yeah. You know what it did before we started really bringing in other people, but we're starting to get to the point where we're bringing in other people and realizing that to explain how to do, once you train them right, to explain how to do something or, getting someone to do something. If they're doing a good job at it, it's not nearly as much work as when we were doing it ourselves. So.
Absolutely. That leads right into the question that I wanted to ask Tyler. Tyler, you guys have seen a ton of growth within this past year. Can you talk about what you guys have done to being able to maintain the quality throughout that time of growth?
Yeah, I mean, I think it's very similar to what Lisa just said. Like systems are so key, But listen, continually identifying pain points, within those systems, and then evolving those systems. I just feel like it's absolutely key. And so, I mean, for example, we just spent the last 30, 45 days where we've kind of been on a pause to revamp our systems. Because as you continue to grow your systems, you need to evolve your systems. So we've spent the last 30, 45 days evolving those systems. Teams are critical as well. It's one thing that Lisa mentioned as well. We have nearly 30 employees, little over 30 employees at this point, who are all dedicated to the systems that we just mentioned, implementing and evolving the systems that we just mentioned. And, you'll be hard pressed to find many syndicators who have that type of, structure and infrastructure in place. But it's because it's important to us, man, quality of life, maintaining care to tenants, and then also making sure that we're taking care of investors and their questions and everything that's, needed there. So just understanding it, man, and checking into it and making it a priority, I guess, is my best answer for you, Jay.
No, that's a great answer. Lisa, I kind of want to talk a little bit more about your operations team that you're going to have overseeing this property, Woodstone Manor. Tell me a little bit about that operations team.
So we have Gibby's Capital, and that is Brett and Megan Davenport, husband and wife. And then there's soon to be son-in-law, Eric Chatterton. And they are really a really tight-knit, really awesome family. We are, people who know me and Greg know that we won't work with, and Ryan and Tyler are the same way. We won't work with most people. A lot of people, we're very picky on who we'll work with. All of us are like that. But that's because, once you have built a reputation the way that we have on, we do what we say we're going to do, and we have integrity and all of those things, and we have our sons working with us too, so we're a tight-knit family operation. We thought that they were a really good choice to bring in, and work with, because they have a lot of integrity. They're really great people. They also have construction. Megan has a construction background. Brett has operations background, and Eric has been a salesperson forever. So the three of them together, what the experience that they have, the extensive experience they have, will translate really well into not only ownership, but asset management. So they live in the Houston area, and they're going to be our boots on the ground, because in every property that we buy, this is how we're able to purchase properties that are not actually in our backyard, where we can have, there always needs to be somebody, our type of asset management is very hands-on. You can't have something on the West Coast and live on the East Coast unless you have somebody that's at least there that can come and check on the property. We don't trust the property management company that everything, everything they tell us is true. Someone has to be watching what's going on. So these guys are going to be there. They're going to be the boots on the ground asset managers while we oversee, from a distance, and then we'll come and check in on things every, probably 4 to 6 weeks, just like we do on our other Texas property.
Awesome.
So really excited about working with them.
Having a good asset management team is crucial. So no, that's important. Thank you, Lisa. Thank you. Tyler, quick question for you. You have a bunch of properties in the Carolinas and in Texas. At a high level, why Texas? And more specifically, why Houston?
I love it. You're great at asking the questions, by the way, Jay. So professional. You're just way more professional. Just professional. I love it.
Someone's got to keep it.
Were you just gonna? I'm pretty sure that he was just about to say you're way more professional than Melissa. Ty?
No comment. Plead the fifth. Listen, Texas. I love Texas. I lived in Austin. for a number of years. And so really, I just want to make sure that I can acquire as many properties there as possible to get back and taste some barbecue and get back in the barbecue scene. We don't have that out here in Maui. And so I need to buy properties that have in areas with good barbecue. Texas has them, especially Houston, but more prominent than barbecue kind of. Just the business climate, man. There's a number of things that we look at, but one of the biggest indicators is job growth and just the overall business climate, because job growth is a direct correlation with. So job growth brings in people. People are that's who live in our product, who need our product, and then jobs give them the opportunity to pay the rent that they need, to be able to afford our product. So we look at Texas. It has a very favorable business climate. Its laws are just like notoriously friendly to real estate investors, as a lot of y'all maybe know that. And then, and I can even speak more in detail about that even later maybe. But on a high level, just the overall business climate there. Now, Houston is, I've always wanted to be in Houston. I really have. Like I started investing, I had some properties in Austin. We have some things in the DFW area. But I had just never really built teams. You can only expand into so many markets, and you can't be everywhere, obviously. But Houston is always I've had this pull there. And so I'm very excited to grab an asset in the Houston market and add that to the portfolio and continue to branch in Texas. Houston is one of the leaders in the US for employment and population growth. I think it was third in the nation for population growth. And then their total employment grew by 4.7% in 2021. And that's great, by the way. I mean, the employment metric that we look at, the job growth metric we look at is anything above 2%. And obviously, that's a little inflated because they lost jobs with, just like every market did in 2020. So they needed to rebound. They needed a big year like that. But I'll maybe talk later as well about why that metric is so important to us as well. But then also another metric we look at is just the affordability gap. Okay, there's a ratio that we research. It's called the price to rent ratio, and all that does, the price to rent ratio measures the affordability of renting versus buying in a given market. And a lower price to rent ratio means that the place is more favorable to home buyers, and a higher ratio indicates that it's a great environment for renters, which we obviously cater to renters. So we target markets that have a ratio above 10% or above 10. Sorry, it's not a percent. And the price to rent ratio in Houston is 19, which is very, very good. We love, like DFW, compare that to DFW. We love the DFW market as well. And the price to rent ratio there is 14. So doing the market, even though I've always been pulled to Houston, like before diving in, like really looking at the stats and understanding what's there, because that's very important. You have to make your decisions not based off of emotion or barbecue, but based on what actually makes sense, what's going on. So that affordability gap is obviously a big thing. It's actually double that of the US. Their single family home price, I think it was like 19%, just under 20% that the single family home prices increased last year, which is crazy, and that's in large due to, in employment, the population growth that we just talked about. So that widened that affordability gap. The affordability gap measures it's just the difference between the average rent and the average mortgage payment, right? So Houston's margin is just under $900 a month. Compare that to, I think it's like $450 nationally. So what does that mean? It means that there's a huge demand for the type of affordable housing that we provide. And, a stat on that, I think it's like 57% of residents in the Houston MSA choose to rent. So that's why Houston, that's why Texas, we love those areas.
I'm sure you know this, but the Houston MSA lost a lot of jobs through 2020 in the pandemic. Lots of jobs were lost. It looks like they're going to rebound, but how do you guys view that?
In short, I mean, good. So Houston employment, I think it fell by, every market got hit, right? I think it fell like 360,000 jobs from February to April of 2020, which is, for perspective there, okay, that surpasses job losses from the 80s oil bust. That was 226,000 jobs that were lost. the Great Recession, there was 120,000 jobs that were lost. So, dude, they definitely took a hit for sure. But it's one of the indicators that we look at, especially in this post-pandemic type environment. It's it's a different metric that we've been looking at recently, but it's what we look at is how they got hit and then how they rebounded. What that shows is it shows the resiliency and the diversity of the within the job market, which is key. It gives us this quick insight. I believe that every negative has the ability to be a positive. And so you look at this and you look at the pandemic and all the jobs that were lost and then how everything was rebounded. It gave us this quick snapshot into the resiliency and the diversity of these different job markets, which has been awesome. So in short, we look at it as great. Like what we need them to be able to bounce back, but there also has to be some room for growth. So to answer that question more specifically, I guess, Houston is very well positioned. As of September 2021, they've recovered, I think it's like 2/3 of the jobs that were lost during the pandemic. The trade, transportation, and the utility sector, they've all surpassed 2019 levels. But unemployment rate is still a little bit higher than national average. It's like 5.5%. National average is right around 4% or 4.5%. But you compare that's down from 14% unemployment in April of 2020. So there's still, what that does at 5.5%, I guess, to be more clear, is that creates plenty of room for employers to still justify bringing jobs into the market. So I don't know if that answers your question. Hopefully it does.
No, for sure. Lisa, I have questions for you, absolutely, but I'm kind of drilling Tyler right now. Tyler, one more before I jump over to Lisa. Okay, so if you had to highlight 3 of the top reasons you choose the Houston market, what would they be and why?
Dude, I'll give you 4 because we usually look at, we call them the 4 major economic influencers. That's what we look at when we choose a market. So those 4 major ones are government, economy, technology, and then some societal shifts. They changed the future just like they changed the past. So, which is why we always keep an eye on those things. And it's obviously no surprise that the Houston MSA performs very well in those. So government, I'll quickly snapshot some of these. You can, ask me more details if you want to, but government, they're like number 1 state in the nation for doing business. They have a super friendly tax environment as well. By the way, they have no personal or corporate income tax, which is great. The economy, cost of doing business is 10% below national average. The national average. Texas is home to, I think it's 49 or something close to 50 Fortune 500 companies. There's thousands of international and small businesses throughout Texas and Houston as well. In fact, Houston ranks number 3 in the nation for Fortune 500 headquarters. International companies are important too, by the way. So international companies help with migration efforts. And Houston has one of the largest international training hubs in the Americas, not just the US, but all of the Americas. And the reason that's so important, okay, immigrants have a higher chance of renting typically, and they rent for longer. So a high percentage of the population growth due to immigration it's a great sign for apartment demand. And then technology, number 3. Can you tell I geek out on this stuff, man? I love this kind of stuff. I do. Looking at reports and stuff, I look at this stuff all the time. I love it. So
I'm glad you called yourself out, Ty, because I was literally thinking the exact same thing.
You're thinking geek.
I never saw myself. But like if you looked at my computer right now in my office, there's like tabs and tabs on market stats and reports, and I love looking at that stuff. But
side question for you though, Ty. Why do you love those things? Why do you love researching those things now?
Because it helps us understand what markets to choose and how to operate within those markets. So we research in 2 different ways. If we're expanding into a market, why would we expand there? We're trying to identify emerging markets, and then operating within those markets. Okay, what is happening within these 4 major influencers or within that market, right? That it could impact operations. And Lisa mentioned it perfect earlier when she said we want to be proactive versus reactive. I believe too many people are reactive. Too many operators are reactive, which is why they then place blame on whatever is happening to them, however they're reacting to it. But if you can stay and you can look at some of these market stats, then it allows you to get into a market to beat the competition into the market, and to be able to then benefit and maximize as that market continues to grow and boom and bust, boom and then before it busts. And so looking at those, that's our job. That's why investors invest with us, man. It is, and it's not just me, by the way. Those employees that we talked about. One of those is, his name's Hunter, is an example. Hunter is better at looking at market stats than I am. And Hunter is continually looking at reports, reading reports, sending relevant information. It's sharing that within the community that we have, so that's why, man, it's my job. I feel like it's my responsibility to do that. So.
Awesome.
Okay, so technology real quick too, because this is a big one. Technology, Houston ranks second in the nation, which is, when I read this is a surprise to me because I was not expecting this, but Houston ranks second in the nation in 2021 for growing tech companies. This is another stat that's crazy. Okay, 50% of tech workers moved during the pandemic. 50%, that's a ton. And Houston ranks second because they amongst the 14 major U.S. metros, because the majority of those, a good chunk of those, relocating from March 2020 to February 2021, relocated to Houston, which is awesome. And the last thing is societal shifts, which is also a big thing, very, very big thing. So cost of living, I would say, cost of living, first off, it's 6%, a little below 6%. So cost of living is 6%, lower than the national average. That's a huge indicator right now of migration trends, is just cost of living. We have remote workers that can work remotely now more than ever. And so they're choosing areas that have better affordability. That's why you have young people just flooding into the Houston market. The median age is 34 years old. Those are prime renters. A good chunk, the far majority of renters in the U.S. are under 35%. And that also aids in a very, just a strong workforce as well. So those are my four, man. That's what I would say.
No, thank you for highlighting that. Those are all super important reasons on why you would want to invest into the Houston area. So no, thank you. Thank you for taking the time to answer that. Lisa, a couple questions for you. Let's dive into the property. We understand that the area is a good area to invest in, but let's dive into this specific property, Woodstone Manor.
Wait, hold on 1 second. Tyler, did you mention about women in Texas?
No,
Oh,
okay, can I mention
Absolutely.
that really quick?
Yeah,
absolutely.
Okay, so I have a statistic here. Me with a statistic. Can you believe
I
it?
love it. Lisa coming in hot.
Texas is home to almost 1 million women-owned businesses, nearly with nearly 150% growth rate over the past 20 years, and ranks third in the U.S. for female-owned establishments. I just wanted to add that in there.
That's huge, though.
Right?
Let me tell you, I love that you just added that, because it's another huge societal shift. And there's more. So women-owned businesses and women in the workforce is increased by a ton. And so the fact that Texas and Houston appeals to that, I did not know that stat. That's awesome. I love that. Awesome.
You're welcome.
Thank you for sharing that, Lisa. No, that's important to know as well. So let's dive into this property. Let's get a good understanding of the property and the story of this property. So I got a few questions for you, Lisa. Why is the seller selling this property?
He's really just changing his business. He's selling off his older stuff and he's getting into new development. So nothing really exciting. Just finished off his time with these types of investments. He has other properties that we actually looked at that he's selling, and this was by far the best one.
Okay, so how'd you go about finding this property from this gentleman?
So actually Gibby's lives in Houston, and they had been working with this broker for a while, and there was a couple of deals that they were working on, and it didn't end up panning out, but the broker ended up feeling really bad, and they had built this great relationship with him. So he said, all right, we'll give you, I think he gave us a few days to put in an offer, but he said, we're getting ready to list this property, but we'll give you first crack at it. So we put in an aggressive offer, but that we knew that the seller would really get his attention to keep him from listing it, but still an offer that our numbers work, and was an offer that is still below market. and we negotiated a little bit, but we also put down a pretty good chunk of earnest money. That's really how we got the attention. That's how we negotiated it. Was lots of skin in the game.
Do you
which
mind?
is what the
Do you
sellers
mind
like
sharing
to see.
do you mind sharing specifics there?
Okay, we gave them $300,000 non-refundable right off the bat. So basically, we went and we did an initial quick exterior inspection before we did that, and checked the area and comps, and we did our homework first. But $300,000 on a deal this size is a very substantial earnest money deposit, non-refundable. So seller, I'm sure would have gotten a lot more had he listed the property, but he knew that we'd be able to close it, and we made it easy. And to have $300,000 hard money off day one, that's really one of the biggest ways we've been able to get some good deals.
And it shows how confident y'all are in the property too. So that's huge.
Well,
and in our ability to close.
Yeah.
That's even a fraction. Like as a GP team, I can't remember the exact amount, but I think it's like 2.2 or 2.3 million that we're investing and bringing in as a GP team.
Right.
So, I mean, we invest in all of our deals, but we don't invest that much in all of our deals.
Not usually. But
Okay,
this is a good one.
Okay, so value adds for this property, Lisa. I'm still going to ask you a few more questions. Maybe highlight some value adds here for us that you plan to do moving forward with this property.
Well, I mean, first of all, we did our numbers very conservatively, and we always do our numbers conservatively. It's one of the ways that we are able to really kill it with every one of our deals. And we, I think every time have actually beat our projections very quickly. Sorry, I lost my train of thought. I looked at a thing, but we've done really well because we are very conservative with how we're always going up on our expenses. We'll always go to the higher end of whatever the rule of thumb is on our expenses. And then on our income, I think this property was 17% below market, and I think we plugged in 14%, and we did it over a large, rather than 12 months, we did it over 16 months. So that's one of the value adds right there. It's just that our numbers are so conservative. So we'll be able to beat our projections. We're, pretty confident about that. This is one of those properties where it doesn't need a whole huge amount of CapEx. So I would definitely consider it a very minor repositioning. The management company has maintained 95% occupancy for, I don't know how many years, but quite a long time. And so it's one of those properties, we've bought properties like this before where it's good. They're running it well. They've got, delinquencies are not bad. We could take over day one. We're going to be making money. But we rather than good, we like great. So we like to take good and turn it into great. And so we're excited about being able to, they actually did some upgrades on the apartments, and they're in good condition. We went through every single unit. We didn't find anything crazy. And so we're not taking anything that's, from like the 60s or anything. This was built in the 80s, but we want to take it, like I said, to good to great. So we're going to come in and we're going to put in some more premium upgrades, some technology features. What are the door locks? The automatic door locks.
Yep.
Yeah. Residents absolutely love that. And in the old days of property management, when we were property managers, one of our biggest nightmares was keys and being able to find keys, and the tenant lost their key, and in the middle of the night we have to go unlock it. So we don't have any of that anymore. We could just do it from our phones. So we like to be able to use technology. Residents absolutely love that. So just adding extra features, adding some, amenities, minor things, and being able to also, we'll start pushing rents by just put in some new appliances and new light fixtures and things like that, and push up the rents. We're not afraid also because we're so good with our property management, making sure that we stay on top of maintenance requests, making sure that our residents are happy. Because one of the biggest reasons that tenants leave is not having their maintenance requests taken care of or feeling like they're ignored. So when you have really good customer service and you're making sure the maintenance requests are taken care of, you keep residents longer, residents are willing to pay more, and you can push up the rents. So what these guys are doing right now is they just want to maintain that 95% occupancy without much of an effort. So we'll put in more effort and be able to get higher rents. And we've done it on every one of our other properties.
Totally.
Awesome.
It's crazy. One of the things that you mentioned is one of the things that I just read, which is the smart locks and AI based technology stuff. They just did this survey that came out, and high 80% range of millennials and Gen Zs said that they would pay higher cost of rent for properties that included stuff like that. And what's interesting about that is Lisa and I, and really our whole team, have been tracking those types of trends, and we implemented all that this past year on our whole portfolio in the Columbia market, same up in the DFW area, and it's been great. Ease and also just quality. Once again, quality to the tenants, appealing to their needs, and taking care of them. One of the things that stuck out to me here was, as I was looking at the stats too, like Houston's rent has increased a bunch, and that's a lot of markets have seen major rent increases. Houston's is over 9% year over year. That's the strongest year over year growth on record. But I want to put that in comparison to this property that she's talking about. You have owners that have been very just more comfortable. It's not a bad thing, but it's a great thing for us. They have the Sugar Land market specifically. The rents have increased over 15% in 2021, over 15%, and the property currently with our projections, 14%. Across all unit types is what we expect to be able to capitalize on with market rents, and even higher, closer to 16% on one-bedroom units. And one-bedroom units represent 50% of the unit mix. So just little things like that, man. Payroll and operational costs down. Those are huge value adds for sure.
A question that kind of came up while y'all were talking about Houston is natural disasters that happen there. I guess the real concern is with the flooding and the hurricanes that come through Houston. Hurricane Harvey, right, just went through there. How does this property look when it comes to those natural disasters?
And that was in the chat box, you said?
Uh-huh.
Okay.
So there was a hurricane that recently came through that actually did not touch this property at all. So it's in a little bit of a better area that a lot of Houston did get flooded, but this property did not have any effect. But of course, this is what good insurance is about. So when we ran our numbers, we put in a pretty high number for insurance because you have to look at the risk like everyone else when you're looking at an area. And so we put in a high number for insurance, and we of course have flood insurance and wind and hail and everything else. So we are covered if the worst case happened, but there was it did come through and we were okay.
Yeah, it didn't get impacted by Harvey either. And Harvey was even bigger. It's not in the flood zone either. But what Lisa said is the key. Like, I believe that, once again, I believe it's what sets Lisa apart is, and I would like to be included in that too, is just looking at the solutions and the, instead of the uncontrollables. There's so many uncontrollables, man. There's so many things out there, especially in this world right now, and what happens is most people focus on the uncontrollables. Uncertainty comes from something in our external environment that we don't understand or that we can't control. And what most people do is focus on more of that, which makes them more and more uncertain.
There's always something to be afraid of. There's always something to worry about. There's always a reason to find not to do something. And if we focused on why not to do it, we would not be where we are right now.
No question.
Right?
I have a mental training coach. His name is Dallas Pruitt, and he always is drilling into my head like, hey, ask better questions gets better results. Better questions gets better results. The quality of your questions. So it's asking better questions, and one of the better questions is like, what can I control right now? And Lisa just nailed it. Flood, fire, wind, hail, all those things are a risk of any physical building. And so the easiest way to mitigate that is insurance. And so
what happens? This is the conversation I had with Nico, our insurance guy, is what happens is if the whole thing, I said, hopefully if we do have a hurricane, hopefully the whole thing gets, I hope our tenants are good first. They move. They'll know ahead of time. They move out. But if the whole thing gets done, we get a whole new complex.
Yeah.
At a very, very, very low cost. So
yep.
We'll end up okay.
Once again, that's insurance, man. It's key. I love it.
Awesome. So Ty, you were kind of talking about the downsides and the risk of the investment. What would you identify that may be a downside or a risk of this investment?
One of the things was what was just mentioned, by the way. For me is I'm like looking at this because I always try to look at, a deal gets brought up and then we try to poke holes in the deal. Because why do we try to poke holes in the deal? Because we're going to get questions like this from investors who also want to poke holes in the deal, not because they're trying to poke holes, but we're all real estate's a risk. So we're all trying to figure out the best ways to mitigate that risk. And once again, that's our job as operators, is to do that. There's risk of any building, of any investment, anything we ever pursue. Now our job is to mitigate. So one of the first things that I looked at, you look at Houston, it was flood zone. Is it in the flood zone? What's the historical history? Did it get affected by Harvey? Did it get affected by the last hurricane that came through? And so that was one that, crossed my mind there. The other one that I would say for the, specifically for the property is they all have, and I can't remember how to, stab lock.
Stab lock.
Stab lock.
Stab lock. Yeah.
Stab lock. Stab lock. You
Stab
got
lock.
it. Electrical.
Electrical panels.
And all of those need to be, replaced. All those panels need to be replaced. And the majority of the units still have those. But we've accounted for that within our capital improvement budget. Once again, so that was, one of the downsides for us. As far as the market goes, I looked at construction. Construction and building permits is something that we always look at as well. Once again, it's Econ 101, supply demand. And the number of building permits, is obviously going to increase the supply, which then will, it will outweigh demand. And that was one of my initial concerns. There's, 19,000 units currently underway in the Houston MSA. That's a lot. But that has slowed a ton, which was ultimately why it then became not a concern. That's in the first 3 quarters of 2021. They had the fewest construction starts, so starting of construction, in over 10 years. As in that same time frame as the population has continued to just friggin' skyrocket. So that was one of my initial concerns as well. But supply or demand is definitely outweighing supply. In fact, the absorption rate, I can't remember off the top of my head, but maybe I can if I think about it later exactly what it is, but it's also very good. One of the best that they've seen in years. And then operational cost was the other one. The expense ratio was closer to 60%. It's way above market average. So then, as looking at that, it's what are those operational costs and how can we fix it? A problem is neither good or bad. It's just a problem. It's an indicator for growth and progress. And but it was a problem for the current ownership. So payroll was one of those. They were paying too much for payroll. I think it was like $1,500 per unit. Ours will be closer to $1,000. Property management fee, I think they were like at 4% or just under 4%. Ours will be just above 3% for property management. And then general admin, there's just a bunch of inefficiencies there that shouldn't have been done. So they were operating at $310 per unit. And we'll be able to bring ours to about $150 per unit. Just once again, simple operational fixes that reduce and mitigate, once again, some of that risk.
So a question to add on top of that, and to add onto one of the things that Lisa said a little bit earlier. Lisa, you mentioned that you stay really conservative in your underwriting to make sure that these deals are good deals. So what measures do you take on that underwriting to stay conservative?
Well, we typically have a rule of thumb when it comes to expenses, and a lot of it's a pretty wide range in some of these, like Tyler was just talking about, general admin and things like that. So even though we'll be able to reduce those from where the current owner has them, we run our numbers at the top. We always pick the top of that rule of thumb. So if the range is, between 300 and 600, we'll pick 600 because we want to consider this. We want to figure worst case scenario in case there's something that we didn't know. And typically we're able to come in under that. So when we put together, those numbers that we put our numbers together when we're figuring out our, cash on cash that we're paying our investors, those are very conservative. But then when we go and we do the actual budget, we're putting the budget together. We're putting we're doing the higher expenses initially, and then we're doing very low expenses when we put our budgets together. And then we're holding the management company to that budget. So basically, one of the ways that we mitigate or we lower our payroll is that I would prefer to have less on staff and pay them more. I would prefer to have them work harder and get bonuses for performance than have extra people standing around and socializing. Because that's what I found is that when you have people, especially when there's a couple women in the office or whatever, I would come in, and surprise them, and I would find them hanging out a lot. And it's fine. I want my employees to get along great. You want them to love each other and smile and laugh. But we also want them to utilize their time wisely. And what we also found was like we had 162 units where we had one manager running the property. It was actually two properties. She kicks butt. And we pay her more. We're able to give her bonuses because she's able to do it. If we brought in another person, she wouldn't be making as much. And I don't think she'd be as productive. So it really helps us be able to keep our payroll lower. So, and then same thing on the other end on income. Initially we're looking at, even though we can push rents to X, we're not going to be pushing it all the way up there on our first numbers. We're coming in and we're going to be more conservative. But then when we give our budget to the management company, we're going to push those a lot higher and we're going to make them work for it. We're going to make them try a lot harder to get it. And if they can't, if they miss it a little bit, it's okay because it's still going to be higher than what we actually wanted. So that's kind of how we do it. That's my secret. One of my secrets.
Totally.
Awesome.
You incentivize off of NOI growth, which is, that's one thing that we learned from you, which I love. It makes just a ton of sense because the property is valued by NOI growth. And so what that does is it gives we want to create some like a pride of, rentership with the tenants. Well, we want to create that pride with, the employees that we have on staff too.
Right.
And that they know, hey, as they're working and they get to this threshold that they're going to be incentivized, but also, man, it's, we're able to incentivize them because they're driving the value of our property up.
Well, our philosophy is we make more, you make more. It's that simple. So most management companies, in fact, even the management company that was going to be doing this property, but I've already talked to them about this and they love the idea. They incentivize just by leasing bonuses. That's how everyone does it. You lease this property, you lease an apartment, you get $50 or whatever it is. Well, why am I giving you a bonus for doing your job? To me, we're going to give you a bonus and it's about the bottom line. It's not about just because you lease an apartment doesn't mean we're actually going to get the money for 12 months. That tenant may not even be any good. But when you actually, for over a 3-month period, you actually increase the NOI, which means that you're not only pushing rents, and they might do it on their own without us even doing it, even though we push them, but you're also reducing expenses and they're looking at the entire big picture. And if they're looking at the big picture and they're making us more, then they should make more. And it works out. And then we even give a little bit of it to the maintenance people because we want their attitude to be good. We want the whole team to be working together to make us more money so they can make more.
Totally.
Awesome. Ty, was there anything you wanted to add to that?
No, that's a freaking great answer.
Okay.
That's awesome.
I agree. Question came in from one of the attendees here that says, this question was probably for you more, Lisa or Tyler. I don't know. You guys can decide who answers this, but your email says you are raising over $7 million in cash for this deal with just over $13 million purchase price and $1 million and a $1 million renovation budget. Seems like a huge raise for the size of the property. What is your loan terms and reserve requirements?
That's a lengthy question.
Loan
term. So loan term is awesome, by the way. Gosh, man, interest rates and debt right now are so attractive. I mean, very attractive. We can talk about how that impacts our exit strategies as well. But loan term is a 10-year term. We have 3 years interest only. Down payments, the property is well leveraged, which is one thing that leverage is great. Being over leveraged is not great. That increases your risk. So down payment is 22, 23%, something around there. And our interest rate is 3.42% fixed, which is just very, very good. Very, very, very good interest rate. And what was the other questions on there? It was
the reserve requirements.
The reserve requirement. I can't remember that off the top of my head. But we keep a way bigger reserve than the lender ever keeps, by the way. So the lender will keep a reserve requirement. I can't remember what it is off the top of my head on this deal.
The
You know that-
the lender's going to be taking it right off the bat by 150,000 for a few small repairs that they want us to do, and then 250 a door per month is
Okay.
what their reserve amount. 250 a door per month, right?
Which is not bad at all. It's actually lower than that's lower than usual. So that's great. And then the other one was
That was it. You answered
Okay.
them.
wasn't it
Yep.
the capital improvement budget though? Something?
No.
Yeah, that's about 1.1.
Okay. And as far as size, didn't you say something with that's a lot for a property this size or something?
Yeah, so I'll reread the question. Your email says you are raising over $7 million in cash for this deal with just over a $13 million purchase price and $1 million renovation budget. Seems like a huge raise for this size of property. And then the questions were, what is your loan terms and reserve requirements?
Yeah. So I mean, the it's not a huge raise for the property. And here's why. Once again, real estate's a risk, and our job is to mitigate that risk. And one of the ways we do that is by building a good reserve up on our own. Not just the lender's reserve. That is, we don't even really look at that as a reserve, man. That's like this worst case type thing. So everything that we raise for our capital improvement budget, that is obviously strategic with what we're raising, but we always over raise. And let me tell you why we do that. Because learning experiences that we've had on past deals, we've made a lot of mistakes. As operators, you don't operate for as long as Lisa and I have without making a bunch of mistakes, but we are very mindful of what those mistakes are and we learn from them. We don't pretend like we didn't make them. We know we made them. Now it's how do we learn from them? And one of those was being underrated. We didn't raise enough on a deal. Which just made us, we didn't get in trouble on that deal, but it was close. If there would have been something that happened, it would have been a whole different ballgame. So we overraised like crazy on our deals. And one of the things, I totally messed up the LTV. What did you say the loan to value was? I just saw 65%. My bad. I messed that up. 65% loan to value, which is even better once again, as far as we look at being, over leveraged. That's very, very good. So that's why.
Anything you wanted to add to that, Lisa? No?
No, I think that was actually a really good answer.
Awesome. I agree.
Except for, wait a second, hold on. One thing, Tyler, I don't make mistakes. Usually just you and Ryan.
That's true. Ryan and I are making mistakes, and Lisa's helping us understand how to learn from them.
Totally.
And at least
kidding.
what it is Lisa and I just clean up your mistakes. That's why you have a team.
Absolutely. I can't argue that at all.
There's the truth.
Awesome. So Lisa, question for you. Tyler mentioned the exit here, and how we exit a property is very important. So how do you determine when to exit, and what if market conditions aren't as favorable when you do decide?
That's a great question. And I actually just saw something pop up about Signal Hill. So one thing that I've been in real estate for a really long time, and we all know and understand market cycles, and Tyler teaches about market cycles. Market cycles, we can predict them. We try to predict them as well as we can. This pandemic was really unplanned, and so it kind of put a hiccup in what we normally would see as a market cycle. So I don't think any of us really even know what that's going to look like. But we do know that trends go up and down. So one thing that I'm always really careful on is I don't want to be in a position where I have to sell a property, or we have to sell a property because the loan comes due, which is why we're doing a 10-year loan on this, because this gives us plenty of time. And then we stress tested and we ran our numbers so that, if we had to sell it in 3 years or 5 years, as long as we're selling it for the right amount, obviously, to cover a prepayment penalty, we can do so. So to give an example, property Signal Hill that we're working on selling 2.5 years down, after purchase, we did not plan on selling in 2 years. We planned, I think that one was a 5 or 7 year hold. But we were looking at the market and we said, you know what, we can make more money if we sell now than I think we can make in 5 years from now. And it was true. We were able to get enough money. So we beat our projections so quickly that I don't think any investors are complaining about the kind of returns they're getting. It's pretty amazing. So we always look at every time that we're making a decision, we're looking at this as what is going to be the most advantageous to our investors, because we want our investors to continue to invest over and over and over and over. That's our goal. So we're not going to sell, just because we don't feel like doing this anymore. We're going to sell because we want our investors to be happy. But that could be 3 years, could be 2 years, could be 5. We always plan on the 5-year. We did a 5-year projection. It could be 7. But as long as the most important thing is we're making investors money, they're getting their preferred return. We see that in the future we'll be able to make more money, or that we're seeing appreciation, that we're making improvements, and that the management is good. And as long as those things are good, I don't see any reason that an investor should be concerned.
Can I mention one thing with that too? Because I mentioned the interest rates and how great they are and how awesome that is, and it comes right in line. So Lisa mentioned one of the learning experience that I had. I used to have this. This is what I would do. Okay, if it was a 5-year hold, that was the plan. I'd put in a 5-year debt piece, which means then what was I doing? I was doing exactly what Lisa said we don't want to do, which is selling the property because the debt piece tells us we have to. But you look at the beauty of what we have right now. Okay, we have very low interest rates, are at historic lows. So this is where we're able to capitalize here. Okay, historic low interest rates. So we project, once again, we don't have this crystal ball. Okay, but it is a very educated, strategic move here. Okay, where we believe the interest rates will rise. Okay, so now let's say that we're 3, 4, 5 years down the road. Okay, it's a 10-year debt term, and interest rates have risen as we expect them to rise. Well, we're always evaluating the market. We're always evaluating, risk versus returns, and what's the best time to do that. Okay, now let's say that we want to exit in, year 3, year 4, year 5. Well, now the beautiful thing that we have is we have the ability to have a new investor come in and assume our loan, because it's a lower interest rate than they'd be able to get on their own at that point, which means their payment will be lower, which means they are able to justify paying more. And that's how we maximize our exits. Now, let's say that the reverse is true. Let's say that we get to year 5, and let's say that in year 5, interest rates have gone down. They went completely different to what we projected it would be. Okay, well, we still have a great property here that is cash flow positive, that we are able to continue to put, making investors returns and be able to do all those kind of things. On the flip side of that, with Signal Hill, we're selling early, but as we sell early and the debt piece, now the interest rate's lower. If they were to bring in a new debt piece, they can get a lower interest rate. So we're paying a prepayment penalty as we exit, but we're okay to pay a prepayment penalty. Why? Because we're exceeding investor returns in year 2 than, what they were projected to get in year 5 to 7. So we have this perfect situation here where we also are able to put in a longer debt term, which gives us 3 years interest only, which means our payments are lower, which is one of the reasons, Woodstone Manor cash flow positive day one. And it is not easy to find a property that is cash flow positive day one in the environment that we're in. So we literally are able to have our cake and eat it too, which
I want cake.
Yeah, and it's cake. That's what we're supposed to do. We're supposed to have it and eat it, right?
Chocolate, please.
So that's the beautiful thing of the environment that we're in right now. So, and I know, Jay, I know that we're coming on. I think we planned for an hour with everybody, so I want to make sure that we can open it up to some questions and stuff like that too. Obviously, I want you to go through any other questions that you may have, but I just want to make sure.
Can I just point out really quick? You don't see this often. The break-even occupancy for Woodstone Manor is actually 63%. You don't see it that low. So I just want to make sure to point that out.
Super, super low.
That's a good point.
Good point.
Yeah.
It's a great point.
Thank you.
One question that did come in while you were answering this last question, Tyler, was what submarket of Houston is this property located in?
What? Sorry, what?
What submarket?
It is in the my mind just went blank. What's the stinking submarket, Lisa? What's the?
Melissa's the one that you usually
It's
answers
the
it.
sugar.
I think Sugarland.
It's
Jesus,
near
my-
Sugarland, right?
Yeah.
my word, Sugarland submarket. Sorry.
And then one more question that came in is, what is the minimum and are the offering docs available to investors to review now?
Yeah, minimum's 100,000. We have 2 investment tiers. In fact, Melissa, do you want to cover the investment tiers real quick?
Yeah. So we have 2 different investment tiers. It's based off of your investment amount. If you invest over 175,000, then you receive 8% in preferred return. If it's under 175,000, then it's 7% preferred return. And our minimum is 100,000. However, we do have a waiting list for anything under 100,000.
Awesome.
Did anybody hear that with the cell phone ringing right in the microphone? Sorry, that's my bad. I apologize.
We heard it. No issue. Didn't even hear a phone ringing. No
didn't hear
stress.
I
it.
was just going to say, wait, my phone wasn't ringing.
No, it's good. I'm so glad. So, and then investor, the positions, I didn't even hear what you just said. So I'm going to clarify this real quick. All of them are first come, first served basis as per usual. So,
and we don't, because we're already so far along in this opportunity, we don't have the full amount available. So if you are wanting to get a part of this opportunity, we do want to make sure that we get your reservation in quickly. That way we don't miss you. So
Melissa, when are commitments, the soft commitment, when are the commitments due by? I know that it's first come, first serve, but is there a date that you're looking for those?
Yes. So we have enough to close, and we are closing this Friday. So we are hoping to have all the remaining commitments in by Wednesday, and then the funds due by Friday.
Funds due by this Friday?
We're closing
This Friday,
Thursday.
y'all.
We're actually closing Thursday.
Oh, Thursday. Yes.
Yeah.
Sorry.
But we have
Yep.
enough to close. Like, I think that's pretty
Yeah.
aggressive. So I think
we
it's
do
pretty
have enough
aggressive.
to close.
Yeah. So I
Yeah,
think
we're-
that as long as, once again, we're bringing in a big chunk and then, giving an opportunity for some investors to replace some of those. So, okay. I love it. So, and then the link you put the link in the chat box. I'm sorry. I can't.
And I can redo that. I'll put that in there again, just in case.
My eyes, y'all, I just had my 37th birthday. My eyes are already, they're shot. They're shot. I gotta readjust where I put my chat box when I do these webinars.
Question that just came in just now is, so I guess at this point we'll open up to Q&A. So if any attendees have any questions, please go ahead and put them in the Q&A box there at the bottom of your screen, and we can make sure that the panelists get those questions that we get them answered. A question that was just asked is reporting and distributions quarterly?
Yes,
Yeah.
quarterly.
But we do a major report every quarter, but we upload financials every single month into the investor portal. And then we also do, a quick little snapshot, but then a more detailed breakdown every single quarter. Yes.
Awesome. Well,
And
if
those
there's any,
distributions, those will be starting the second quarter of 2022. This property is cash flowing positive day one, but we do want to stabilize the property. So to do that, we are withholding distributions until the second quarter. However, just as y'all know, like we do with all of our properties, we always do a catch-up provision. So if for some reason any of those those distributions that are missed on the front end, then we do catch that up on the back end.
Once again, just being conservative. We always like to see some operational history, and especially takeover such a critical process or part of any, the takeover process is just a critical part of what we go through. Melissa, did all your lights just turn off there?
Yep. Just shut off. I think that's the office's way of saying, get your butt home.
That's awesome. So yeah, we
pay your bill.
Build a reserve, but you'll see any preferred return that's missed in that first quarter will obviously be caught up, like Melissa said.
Yep.
Anything else, Jay?
not that have come in. No, if anybody has any more questions, these guys would love to answer them. So please throw them up in the chat box or in the Q&A box. Either way, we can make sure that they get answered. I guess I have one more question for you, Tyler, and for you, Lisa. What makes you each most excited about acquiring another property in Texas? Ty, we'll start with you.
Yeah, I love Texas, and I've been wanting to expand, and Lisa knows this. We love the Carolinas, and we've been so active in the Carolinas. for the last couple of years that we haven't needed to go into, to other markets, but Texas is always, I love Texas. Once again, lived there before I moved out here to Maui, and love everything as far as just the demographics and the growth that's happening there. So we've started to branch out into the DFW area and now down in Houston. So I'm more than anything just pumped to bring another investment opportunity to the investors that's in Texas. And then selfishly for myself, I love to travel those as well. So
I'm sorry. All I took from that is everything's bigger in Texas.
Everything's bigger.
That's what I heard.
Including returns.
Plus give you capital. You got Megan, Brett, Eric. They're all out there in Texas, which gives me just more opportunity as well to be able to spend some time with them as well. So
awesome, Lisa.
I mean, who doesn't love Texas?
I don't know of anybody. I literally don't know.
Well, I'm freezing my butt off in Utah, so right now I really love Texas.
Awesome. Well, that answers all of the questions. Is there anything else that Tyler, Liz, or Melissa and Lisa, that you guys want to add before we wrap up here?
I'll add one more thing, and just grateful once again for everybody. You just spent, I can't see, but I know there's a good chunk of people on this call. You just spent an hour with us and asked awesome questions. I mean, a lot of those questions that Jack's polled were from the chat area there, and just grateful once again for your continued partnership, your trust in us as operators. And then thank you for Lisa and Melissa and Jackson. Appreciate you guys as well. So that's it.
Thank you.
And most important, thank you to our investors. I continue to be so humbled as we continue to acquire these properties that these amazing investors trust us and continue to see, the growth that we're having. And it's so incredible to see that and be a part of that. So thank you to each and every one of you.
Couldn't
I
agree
agree
more.
with all of that. Thank you very much.
Thank you.
Appreciate it.
Yes. Thank you all for your participation today. Tyler, Lisa, Melissa, thank you so much for your guys' valuable time spent here today answering these questions. If you guys need anything, Melissa, do you want to put your contact info in the chat as well? If anybody has any questions, they can reach out to you. The investment reservation link is also in the chat box for y'all to go start filling that out as well. Awesome. Well, if that is it, thank you so much, everybody, for joining us. Have a great rest of your evenings. And if you guys have any questions or need anything, there is Melissa's info, melissa@mfcapitalpartners.com, telephone number 808-460-6008. Please reach out.
And don't be confused. I'm not enjoying the Maui sun. Even though it's an 808 area code, I am not. That's why I'm white as can be.
Look at me.
Yeah.
It's a great thing.
Awesome. Have a great rest of your night, everybody. Thanks for joining us. Take care.
Appreciate it.
Thanks,
Thank
you guys.